joining us. Very excited to have you. This is the final webinar in the R&D presidency, so I'm very, very excited to have you guys. I am the COO of Interlink Mortgage, and for the next couple days at least, president of the Texas MBA. So the idea for this webinar really began in December of last year as we continue to watch the delinquencies rise, specifically in the Ginnie Mae space on FHA loans. Those of you guys who talk to Nolan ever know that this is kind of an alarm bell he's been ringing for a while, and so it's not news to us at Texas MBA. Texas does originate more HUD loans than any other state, and that means we also right now have more delinquent HUD loans than any other state. And so as president of the Texas MBA, I really felt an obligation to address these rising delinquency numbers, what is causing them, and to help foster an educational dialogue to ensure that you guys, our members, know how to manage default servicing. And at the same time, we've also seen a few changes come out that impact Ginnie Mae servicing specifically. So this all seemed to come together really, really well. And we are very fortunate and lucky at Texas MBA that we have some of the top industry leaders in this space as part of our membership. And so I'm really excited today to bring you guys the voices and expertise of two of these leaders. We are going to discuss the data behind what's causing consumer stress, take a deep dive into delinquency numbers, review recent policy updates, and finally, we will cover some important questions you should be asking your subservicer as part of your oversight practice. So I will go ahead and introduce our speakers. The first one should be well known to many of you who have been in the TMBA space for a while. Nolan Turner, he's the managing director for Carrington Holding Company. He leads Carrington's strategic initiatives, growth and revenue objectives, and industry partnerships across Carrington's 8 vertically integrated companies and over 4,000 employees. Nolan brings 20 plus years of experience across the entire mortgage life cycle, cap markets, lending, servicing, default management, title, real estate, RMBS, MSR trading, and all the other things. Prior to Carrington, Nolan held leadership roles within the investment bank at Wachovia and lending operations at World Savings. Nolan is an MBA future leader, a CMB, serves on several boards, including TransUnion, the Mortgage Bankers Association, the National Mortgage Servicer Association, and he is also our current Secretary Treasurer, soon to be Vice President next week. He also holds advanced postgraduate degrees in cognitive psychology and quantitative analytics. Jesus, I can't talk, sorry. Finally, I also want to introduce somebody who is fairly new to the TMBA membership, though some of you may know her very well. She is brilliant. Marissa M. Yaker, Esquire, is a recognized thought leader in regulatory affairs, creditors' rights, and mortgage servicing compliance. She serves as the Assistant General Counsel and Vice President for Paget Law Group, a new TMBA member, a full-service creditors' rights law firm servicing clients across 13 jurisdictions. In addition to her role at Paget, Marissa also serves as the board chair for the American Institute of Servicing and Legal Executives, also known as ILE. Marissa is licensed in the state of Florida and the United States Supreme Court, and I'm so excited to have her here. So we're going to go ahead and get started. Nolan, let's kick us off.
Great. Thanks, Erin. Pleasure to be here, and certainly excited to talk to you guys today. I think it's like a really good way to probably kick this thing off. I always like to kind of start where you want to end, right? And I think the why and the how is probably just as important as anything you're going to cover. And all of us on the phone, almost every single business that exists in the world really revolves around consumers. So I think I'd like to start there, kind of give you guys some background about what is really going on in the market. And the reason that I kind of put together this data is a lot of the data that you see is wrong, or it's misinformed, or it might not necessarily be applicable. And when you're running a business, million, billion-dollar businesses, right, getting the data right is critically important. So what I've tried to do is show you what's really going on with consumers. And some of this is good data, some of it's, maybe a little doom and gloom, and I don't mean it to be that way. It's certainly not meant to be. It's certainly meant to be factual, and there's opportunity here because if you can understand the data, you can probably make a lot of really good decisions that are going to be extremely impactful to your portfolio. So with that, maybe we'll get started and kick things off. So let's start with consumers, and here we go. So when you guys hear inflation numbers and you hear the CPI and CPE number and they say it's 2.73%, it's not. That's really not the number. the true inflation numbers are what you look like here, right? Where prices since COVID have probably went up 20 or 30%. And for those of you who go to the grocery store or the gas station or you go out to eat, you've seen these prices surge, right? And I know some of you are probably thinking, well, what about property tax and insurance? And we'll get there. You'll see that in a second. So while prices have went up, 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 there is something that has not went up, up, up. And that is household income, right? It's the income's pretty much finite, right? 76% of the households make less than 150 grand a year. So when you hear things like a K-shaped economy, think about the letter K. The top part of that K, that's people who make more than 150 grand a year. The bottom part of that K, that's $150,000 a year less. And that's 76% of households. Some of the data says that number is really as high as about 80%, 81%. So there's a huge amount of the American public, and this is household, not individual, that make that. If you want to be the 1%, you got to make 700 grand a year. We know how hard those jobs are. That's why they're the 1%. So this is where most people sit. And a lot of people in Ginnie Mae loans, especially, they're less than 150 grand a year in income. So when you look at something like the affordability problem, which is near and dear to all of our hearts, this is what's going on. You have median household income that's went up about 7% since 2018. And you have median home prices that have went up 30, 40%, maybe even 50 to 100%. I live in South Lake, Texas, here in the Dallas area. My house has doubled since 2018 when I bought it. So one thing that you often hear is, well, real wage growth is up. That's 100% true. But that real wage growth is often applicable to people who maybe had an hourly job at, call it a fast food restaurant, McDonald's, right? They used to make 8, 10, 12 bucks an hour. Now they make 23, 25. So that wage growth has went up, but the median household income year over year, it's been flat. So there's a little bit of discrepancy there in the statistics. So how do we know things are kind of tough? Well, you know things are kind of tough because of this. When you see people hitting the 401ks, they go to the piggy bank, they don't have enough money. That withdrawal rate from a 401k is up 250% in 5 years. And what are they using the money for? To pay off credit card debt, cover medical expenses, emergency expenses. Some 20% just make ends meet. And if you think about the housing market today, think about this. What are rates today? 6.5, 6.25%. And 40% of the market is refinances, right? At Carrington, we have about 1.1 million loans, and we probably do 80% refi on that servicing portfolio. And people are trading in 2, 3, 4, 5% rates for 6.5% rates. Cash out refi, pay off debt. We see it all the time because that 6.5% rate is a lot cheaper than the 29% credit card rate. So speaking of credit cards, this is what that credit card balance looks like, right? It hasn't quite doubled since the great financial crisis, but we're kind of close. You know, we were 830 billion in 2008 at the height of the financial crisis, and now we're at 1.27 trillion. So the amount of debt consumers have total is about 21 trillion. You know, we're 1.27 trillion right there in just credit cards. So this is showing that borrowers are using more and more credit. And why do you have a credit card? Think about it. You have a credit card to buy things you can't afford, right? And maybe you're a points guru like I am, and you want to travel and do your hotels and flights and all that. And yeah, some of that's probably here. But consumers are definitely overlevered. It's something that we see all the time. And you'll see it a little bit more when I get to the debt to income slides in just a few minutes. The other
Nolan,
thing that we're seeing in the market
Nolan,
for
I want to
consumers is we're
jump in
seeing,
really quick.
oh,
Nolan,
sorry,
sorry. I
go
want to
ahead.
jump in really quick. I just wanted to highlight that Freddie Mac released their mortgage rate. Every Thursday they do it. It went down to 6.23% today. Last week it was
Oh,
6.3. So we did go down. I wanted to highlight that. We, focus on something positive. So
that
I'll
is
let you
good.
continue.
I think we're probably higher longer on the rates, to be honest.
Mhm.
And we can talk about rates for a little bit if you want. It will the Fed cut rates. It's one cut is kind of in the dot plot right now. Who knows with what happens with the volatility in the war and all that. But these rates are probably going to be 6% ish, 6.25. If you have the war kind of get worse in Iran, that those rates probably go up again because of inflation. So I think like it's gonna be tough sledding as far as the origination. I think what you probably see instead of rates going down, I think you see some housing prices start to soften a little bit.
Well, since we were talking about rates, and we didn't talk about this before the call, so I apologize for putting you on the spot. But for some of us, we know that the confirmation hearing for the new Fed chair was on Tuesday, I think it was,
Mhm.
with Kevin Warsh. And during that whole entire confirmation hearing, they were talking about, obviously, there's with the Fed being a little bit different for the Fed rate, but whether or not he was going to cut rates if confirmed, which I believe they have until May 15th to confirm him because Chair Powell's term ends May 25th, and what that would look like. And during the confirmation hearing, Warsh was stating that he was going to utilize AI too for like looking at monetary policy, which I thought was really interesting.
That is very interesting. And even if Warsh gets in, I think Powell still has the ability to sit on the Federal Reserve
Yes.
Board until 28, right?
Correct. That is
So
an
you're going to
option.
have
Yeah.
some people who want to cut rates. You're going to have some people who don't. If you cut rates, I think you certainly see more inflation. We saw the inflation numbers earlier. That's my biggest concern. And then second point is on the rate cuts, you got to remember who really buys a mortgage, right? You look at the Fed's fund rate, it's overnight. It's 24 hours. You look at a 10-year treasury, it's 10 years. You look at a mortgage, it's 30 years. Now, does the mortgage last 30 years? No, it probably lasts 6 to 8. So it's closer to that 10-year treasury. But at the end of the day, the MBS investors are 100% in control of that price. And they care about prepay speed. So if they think rates are going to go down, they're going to charge more because that loan will pay off sooner. If they think delinquency is going to go up, or they think people are going to sell their house, it's a payoff. They think loan mods happen. A loan mod could be a change in rate. It could be a new loan. It's a payoff. So they're going to protect themselves for those higher prepay speeds by charging more, which keeps rates higher.
Yeah, and we can get into it later too in reference to the loan mods and where most people are currently on a rate right now. And then if they go into a loan mod, it might actually make the rate higher. But I'll let you go with the credit card delinquency.
100%,
Because that's
100%. I love the talk.
Yeah.
So credit card delinquency is up, but it's not that bad, to be honest. We're, definitely up since COVID, 3% ish. It's been a little flattish. One of the reasons you see this number flattish is what I have highlighted here, where it says excludes severe derogatory and bankruptcy. So a lot of times when you see data, how many of us read the footnotes? Not a lot, right? If a loan is more than 90 days delinquent, it is severely delinquent and it is kicked out of all of the delinquency data here in the credit reporting. And same thing with bankruptcy. When you file bankruptcy, you're not reported. So there's a lot of missing data in here that if it was shown, the numbers would be a little bit higher. During the great financial crisis, this number was probably closer to 6%, 7%. So we're not nearly as bad as we could be. When you look at auto delinquency, though, auto delinquency today is worse than during the great financial crisis. If you look at subprime auto delinquency, those with the 680 FICO, which I don't really consider subprime 680, but that's the number, that delinquency is worse than the subprime financial crisis. So this auto thing, again, so no severe derogatory, no bankruptcy. So this data is probably a little bit worse. If you look at something like bankruptcy, it's up. Most servicers, if you said, hey, year over year, what are you kind of seeing for bankruptcy? It's probably up 20% for most servicers year over year. But you can see the rates there, and bankruptcy is nowhere near where it was after the financial crisis when you were, 10, 12, 14%. We're in the, 4 to 6% range today. So it's certainly manageable. One thing we are seeing, though, is we're seeing about 20 to 30% failure rate. So people go into bankruptcy, the judge will give them 1, 2 bites at the apple. They come back for the third bite, judge kicks them out of bankruptcy, and the foreclosure proceeds. We're seeing a lot of people in foreclosure today. Right before foreclosure happens, they file bankruptcy to save the house. That's a really interesting phenomenon. It's something to watch if you own
Hey, Nolan.
servicing. Yeah, go ahead.
So one thing I'm kind of struck with this kind of connecting dots on this data, right? So first you kind of talked about how much equity we have and that you're seeing a lot of cash out refis. I think we are, and it's debt being paid off. And so right now, consumers are able to use, if they get stressed and in trouble, they are able to use that equity that they still have from the COVID time to pay off some of those credit card debts, which might be why those delinquencies aren't significantly elevated. But you also referenced to we might start see a softening in home values. So if that is the case, then that might impact these numbers as well if people are no longer able to tap that equity.
Yeah, no, I agree with you. I think that that's a very astute observation, and there's a lot of equity that does still exist. One thing that is important to note is if you look at the New York Fed data and you look at the amount of refis that fail, and if you have Bloomberg, you can go to Bloomberg and look at that as well. The failure rate on these refis that you kind of start the process but it never closes is north of 40%. And you kind of wonder why. Did the people just change their mind? Did, rates have been volatile? Did rates go up and maybe they didn't qualify anymore? Is there a DTI issue? Is there an LTV issue? So you see a lot of people who want to do a cash out refi, take that equity, and with a 40% failure rate, that's a little high. And it's the same thing on credit cards. Credit card denial rates for kind of extra credit are about 20%. So you've seen a little bit of tightening, I think, in the credit markets.
Nolan,
Yeah, questions, go ahead.
Nolan, I read a report recently in reference to auto loans, and I can't remember where it's from. It might have been from one of the feds. And it was talking about seeing the increase in delinquencies and auto loans, and they were trying to figure out why we've been seeing an increase in them. And one of the comments in the report that I read stated that people are being put in cars that they can't actually afford. And it kind of sounded familiar to me, but like back from the 2008 financial crisis. So I kind of wanted to pick your brain on that.
Yeah, no, I think that's 100% true. I think what's happened, right, is it's a little bit like the mortgage delinquency, which we'll get to here in a minute.
Mhm.
And at the time when they applied for that auto loan, they probably could afford it. But then their car insurance went up, and then their mortgage payment went up, and then inflation changed, right? And a lot of times what's happened is when they bought that car, they probably overpaid. Remember during COVID, all this stuff was way more expensive than MSRP. You were paying anything you could to get a car. And some of those borrowers are actually upside down. So they've been forced to stay in that car longer. And you've also seen some of those loans get refied where they try to extend the term, right? So I think it's usually borrowers have great intentions, and I think the people who make loans have great intentions. No one wants to harm anybody. It's just life happens sometimes, and that's what we're seeing a lot of.
Agreed. And
Yeah.
Nolan and I talked about this before the call because I was like, you didn't put student loans in here. Student loans are part of the conversation, right? And so Nolan stated before we joined too that, there's mixed data on the student loan data, but we do know that Treasury entered into an interagency agreement with the Department of Education back in March in reference to the nearly 1.7 trillion loans that are currently with fewer than 40% in repayment plans and almost 25% in default right now. So I'm curious to see how that's going to impact everything too in reference to Treasury actually trying to collect on these loans.
Here's what I'll say. I've had conversations with both HUD and Treasury at the highest levels. And one thing I'd love to point out is just how cooperative and how receptive both agencies have been. I sit on the board of governors for the MBA along with Aaron, and the MBA's had a lot of conversations. Treasury and HUD have pulled people aside privately and said, hey, we really care about our borrowers. We want to do the right thing. What do you see and what do you know? And it used to be, honestly, if you go back a year ago, if you had a federal student debt and you were delinquent on that debt, you couldn't get a loan mod. And HUD did everything in their power to change that and to make it a little bit easier to keep borrowers in their house, which was like a huge saving grace. At one point, Treasury said, you're delinquent on your student loans, we're going to garnish your wages. And the wage garnishment would have been 15% of your disposable income. So you saw the income chart, you make 80 grand a year on average. That's the median, right? That's about $6,666 a month. They would have taken about $800 out of people's paychecks if they garnished wages. And Treasury said, the timing's probably bad. Like, we don't want to kick people when we're down. We want to give people a break. So it's been, there's been a lot of thought around the student loan thing, but it is a serious problem. Probably about 30 to 40% of every Ginnie Mae borrower has a student loan. and a significant percent, like you mentioned, Marissa, are delinquent. I think it's probably 20 to 30% delinquency in student loans right now.
Mm-hmm.
Yeah, and
Correct.
there's a lot going on there with repayment plans and save plans and other stuff where they're trying to, make this palatable. But again, you only have so much money and you have a lot of debt and you have inflation on top of it. So things are tough for student loans. And 30 years of school, I still pay my $1,500 every month to my student loan. I love it. It makes me so happy every time I write that check.
Well, I like to point out too that the Federal Student Aid Office actually publishes the default rates by colleges. So for those of us who may be thinking, oh, what colleges are children going to? I like to look and see which colleges have the highest default rates too, just
So
because I
what
think it's
college do you have?
important.
I'm curious. What is it?
They publish it on a quarterly basis. It's a request for institutions to update and maintain default management. And so it literally publishes it. I'm not going to name the colleges during the webinar, Nolan, but you can go to it and look at it and you can see, because I just think it is an important tool, right? For those of us that are looking like, oh, what college should our child consider? Which, by the way, I'm not anywhere near that for the record. Thank goodness. I'm going to enjoy the younger years for much longer. But when it does come, I like to know I have that data at my fingertips.
I love that. I want to talk more about that.
Mhm.
So moving on, consumer sentiment, I think, is really important, right? All of us who run businesses, you probably look at countless reports, data, analytics all day, every day, and you're really good on the qualitative side. What about the quantitative side about how people feel, right? If you don't feel good about making a purchase, buying a car, buying a house, entering into some type of financial transaction, that feeling translates into behavior. That action never happened, and the consumer sentiment is extremely low. There's probably a lot of bias in here. This cell phone thing is kind of a problem. We get news all day, every day. Some of it's true, some of it's not. It probably has a huge influence here, but it's important to know because if people don't feel good about something, they might not do it. So, any questions before I go on to the mortgage credit box at all? Nope, good.
I don't see
Okay,
any in the chat, but I'll let you know.
got it. So one thing I think that's important to pick out here, and just to be really clear, I'm not picking on Fannie, Freddie, or Ginnie, just showing the data of what it is. And what you have is you have a pretty clear delineation between Fannie Mae, Freddie Mac, and Ginnie Mae. Fannie and Freddie have taken a little bit of the higher credit quality, higher FICO, lower LTV, lower DTI. Ginnie Mae has really stepped up, opened up the credit box a little more to try to bring that affordability back into the market, make people, homeowners, generate wealth. And as you can see here, 65% of those FHA loans have FICO scores of less than 700. They have higher LTVs. They have higher DTIs. And this is just a factor of, I think, the mission of HUD, right? And it's really important. It serves a huge mission. When you look at the FHA credit box, higher DTI is the norm. So if you look at that 43 to 50 and greater than 50%, HUD FHA is taking, I don't know if you want to call it a lot of risk, but they're definitely taking on a little more credit risk than Fannie and Freddie are, with about 60% of those borrowers have a DTI of higher than 43. FHA does allow up to 57% DTI. So one thing that we've seen in the servicing world is a lot of times the borrower comes in with the higher DTI, let's just say it's 57. The borrower pays federal income tax, right? Yep. And if they make 40 grand or 100 grand a year, what federal income tax bracket are they in? They're in the 22% bracket. So the 57 DTI kind of starts off at 79. And you said, well, Nolan, you showed us a bunch of inflation data. Like if they're paying more for all these items, a lot of those items aren't included in DTI, right? Healthcare, daycare, utilities, groceries, maybe you got like a bunch of other stuff like cell phone, internet, gym memberships. None of that's included in the DTI. So that 79 DTI might be 85 or 90. And if they have a problem with home insurance or property tax, then things get really, really bad. They could be well over 100% DTI when they started the loan in a really healthy manner. So I wanted to point that out because that's the number one thing that we see in delinquency. They started out okay, and then life happened. So we're good? Question? No? Keep going? Good. Okay. So on delinquency, this chart is something that is a little bit of a misnomer too. This is, the data shows one thing, the true story is another. And if you look at what happened during COVID, delinquency spiked. A lot of the agencies came in and they made decisions to put a lot of stimulus into the economy and to do everything they can to help keep borrowers in homes. And it probably started off a huge, huge foreclosure crisis. So that process under the COVID era act went on from 2020 until late 2025. So if you see in Q4 of 2025, that delinquency went up a little bit, right? Why? It's a great question. So if you're a servicer, at what day do you modify a loan? Day 89, day 90. Seriously, delinquency starts at day 91. So if all of these loans get modified at day 89, day 90, and they never go seriously delinquent, that's why you have the flattening. And you're probably going to ask, hey, what happened in Q4 though? Why did that number go up? Well, HUD changed the loss mitigation policies. It used to be you could have unlimited loan mods to a point, right? It used to be that the loan mod did not require a trial payment plan for an FHA loan. In October of 25, FHA changed that, HUD changed that, and now you can only do one loan mod, one partial claim every 24 months, and you have a mandatory 3-month trial payment. So that's the reason for the spike, and I'll show you the outcome of that delinquency here in just one sec. But the reasons for delinquency are exactly what we talked about earlier. The reduction of income, excessive obligations, which really translates into things cost too much money, and I don't make enough. The important part on this slide that if you own servicing, you should really care about is the no contact bucket. And that's something we've seen a lot more of in the recent year or two. And that the borrowers just are not taking the calls anymore. I think a lot of those borrowers have came to the conclusion, look, I don't have the money. How am I going to pay this? I know you want to talk to me and try to work something out, but I've already did 1, 2, 3 loan mods. I failed them. Like, I don't know what I'm going to do. So the borrowers did a little bit of the ostrich, right? They put their head in the sand and they just don't want to talk. So it's been harder and harder over the last couple quarters and years to get borrowers to talk to you. And I think the real reason is this, right? This is the number one reason that we see, and it's escrows. It's property tax and home insurance. Are borrowers overlevered on the credit card? Sure. But the escrows and the percentage of mortgage payment, these numbers should be in the 20s. And you look at Texas, you look at Florida, you look at some of these other states, and they're a lot higher than that. If you look at just home insurance, Texas has went up more than $5,000 since COVID. Your buddy Nolan Turner over here, my home insurance went from $4,000 to $14,000 during the 24-25 year. And you know what's really interesting about that? I own the insurance company at Carrington. So I call my buddy Ross, who I gave a job to, and said, hey, how do you like that CEO job? It's great, right? Hey, Ross, what the F happened to my house, dude? And he says, we knew you were going to be mad. I'm like, $4,000 to $14,000? Like, come on. And he said, look, we work with 52 carriers. We shopped all 52 of them. That's the best rate. I said, well, I want to see all 52 quotes. He's like, you got 9. What do you mean 9? 40 plus people didn't want to write the policy. They didn't like my house. They didn't like my zip code. They weren't doing new policy, whatever it was. And since I have trust issues and I work in the mortgage industry, I backdoor the guy. And I go shop 7 other carriers, and the best deal I got was $17,000. So his $14,000 was the best deal. Now think about that for a minute. If you are the underserved borrower, maybe English isn't your first language, maybe you just don't understand insurance because it's complicated and complex. Are you going to shop 52 carriers? I mean, maybe 60 carriers? No, you're probably just going to pay it. And that's what we've seen in this home insurance and property tax that just hurt a lot of people. And that translates into this. This is the real delinquency, right? And you can see from March of 2024 to March of 2026, so about 2 years, we went from 781,000 up to about 1.1 million delinquent loans. That's a pretty big jump. And when you look at things like the 180-day bucket, if you look at October there, 2025, when HUD made that change, you can see the delinquency there in the 180-day bucket, 160, 180, 200, 225, 247, 263. It's really jumped up. Now, don't be too alarmed by these numbers. The data might look bad, but what's really happening here is when the borrowers go through those mandatory 3 trial payments, they're considered delinquent until they come out the other end. So some of that is going to clean up. The question that I get most often, well, Nolan, how many borrowers come out? What is the percentage of people who fail in these FHA loans during that 3-month mandatory trial payment? So those numbers range from anywhere from like very, very high 30s, low 40s up to north of 50%. So we're seeing high touch specialty servicers like at Carrington, for example, we're very low loan count per employee. We're extremely proactive. Our failure rates are in the high 30s. Other servicers who are more big box, less high touch, their rates are closer to 50% are failing the trial payments.
Nolan, I'm going to jump in here too. So
Please.
when FHA published their annual report to Congress too, going back to when you mentioned the 1 mod per every 24 months, FHA stated that it was projected to save them approximately $1 billion by doing this. And then kind of going into the defaults increase, and that's been the whole industry conversation, right? Since October 1st, everybody's been saying, oh my gosh, there's so many loans now currently in default. And so the Ginnie Mae Global Market Analysis report was just published on Friday last week. It's one of my favorite reports. If you don't read it, I highly recommend reading it. It has really pretty charts and it covers so many different topics. But anyways, within the report, they were stating that from October 25, when the new permanent new permanent waterfall changes went into through February 2026, the Ginnie Mae single family loan portfolio reported an average monthly delinquency ratio of approximately 9.2%. This represented an increase of approximately 90 basis points compared to the preceding 12 months beginning in October 2024, which back then it was 8.3%. So kind of like focusing on what Nolan's saying, a lot of these changes are related to it. But prior to that, and I think Nolan, you would agree with me, is we were watching redefault rates too for a long time too. I don't know if you want to jump on that, but redefaults were significantly higher and trending higher too. I mean, from quarter 4 2023 through quarter 4 2024, based on the annual report to Congress published by FHA, it was steadily within the 50% range.
Yeah, and here's what I'd say. Like as a statistician, I look at the numbers like very differently, very scientifically, right? Try to take all the emotion out of it and be extremely objective. And the data that I pull often comes directly from Ginnie Mae and the federal government. And it's the data that MBS investors get. So if you're buying a QSIP, if you're buying MSRs, you're really heavy in that data looking at redefault rates, prepay speeds, churn, where those loans are, where they're moving from. And what we see on the redefault rate is you see about 60 to 62% redefault rate on partial claims or loan mods, 30 or 40-year loan mods. And so what happens is maybe you modify a loan in January and you say, well, I'm going to look in May or June and see what that loan has done 4, 5, 6 months later. When you look out 4, 5, or 6 months, that's where you get the 60% redefault rate. And again, prior to October, you could have a loan mod. You could pay for a month or two. You could blow up, go 30, 60, 90. And remember, day 89 or day 90, you modify again, so it never goes seriously delinquent. You didn't pay for 3, 4 months, right? So now you got some cash. You clean up, you pay for a month or two, you blow up again. When you look at the amount of partial claims, I want to say the number is close to about 2.5 million total partial claims have been done. And greater than 45% of those people have more than 3 partial claims or 3 loan mods. So you've seen a lot of recidivism come through. And I think the data, like this will clean up the data, even though this data here looks really bad at the 180-day bucket. If we have the same conversation again in the fall, you're going to see who comes out, who cleans up in trial. I anticipate it's probably going to be 35 to 50% of the people will be okay, will like make it through no problem. I think it'd be okay, but there's going to be a fair amount of the trial people who just they won't make it, or they will redefault. When they redefault, they'll go immediately to foreclosure because it's one loan mod every 24 months now, instead of being able to recycle through. So if you own servicing, the thing you should care about, why am I telling you this? You need to know this because your servicing advances can go up in a big way, right? And the other thing that can happen is this, and that is, and again, I'm not picking on anybody here, just to be really clear, this is all publicly available data. But what's really going on is if you look at smaller IMBs and you look at the level of delinquency, especially when you go through trial payments, and you look at what Ginnie Mae cares about, DQ2, DQ3 ratios, this is chapter 18 of the Ginnie Mae guide, you can see where those numbers are. DQ2 needs to be under 7.5. DQ3, or your 90-day delinquency, needs to be under 5. And if you're red over there, you've kind of tripped that threshold, right? Why is that important? It's important because it's a material event, because you're in violation of Chapter 18 of the Ginnie Mae Guide, and you need to notify your warehouse lenders, which your warehouse lender could say, hey, no problem, we get it. It's this trial payment. We know why it spiked. They could say, we're going to margin call you. They could say, your warehouse line is done. They could say, we'll give you a covenant waiver. We'll give you a 60, 90, 6 months, clean it up, figure it out. But those conversations are starting to happen now. What's really great is Ginnie has been all over this. And Ginnie, I believe, is coming out with an APM. Don't quote me on this, by the way, but I think they're trying to come out with an APM, some policy around possibly taking DQ2 and DQ3 out of that calculation for loans that are in trial payment plans.
That'd be really
Marissa,
interesting.
you care to opine? I know
Yeah,
you're close to all the policy
I
stuff.
haven't heard that, but that would be really interesting in reference here because I know Ginnie Mae, I mean, I referenced it just now that they're focusing on the FHA increases in delinquency. So we do know that they're looking at this data very closely. We also know that currently Ginnie Mae is stepping in the shoes of the FHA commissioner for the time period, Joe Gormley. So I think that there's a lot of conversations happening right now. And by the way, since we're talking about them, their new office is absolutely gorgeous. I think Erin would agree, right, Erin? You just saw it too.
Absolutely, it is. It is.
Yeah.
And actually, Mr. Gormley will be at the TMBA annual convention next week on Tuesday speaking. So hopefully we can get some additional insight from him then. Yeah, we're excited to have him.
Yes.
Yeah,
So,
I think Gormley is one of the best guys we've had come through that Ginnie Mae shop in a while. You know, he's an ex-mortgage guy. He gets it. He's extremely astute in terms of the capital markets, how things really work in servicing. You know, the staff that HUD has and Ginnie Mae have, they've worked tirelessly to really work through a lot of this stuff. And in my 20 years of doing this, I don't think I've ever seen more cooperation, more conversation, more accessibility, and more willingness to say, how can we help? I mean, they've really been great to deal with.
I concur on that front. They're
One
always
thing I
willing
did
to
want to kind of highlight is how that process really works, right? Because loss mitigation, I think it's a little bit confusing, right? But I wanted to kind of spell this out for you guys so you can really see things that you should think about if you own servicing. And this loan mod partial claim timeline, this could vary by a month or two either way, but this is typically how it works. So a borrower goes 30 days, 60 days, 90 days delinquent. And they often call the servicer and say, hey, I missed a payment. To which the servicer says, well, hey, you've already missed 3, buddy. What's 4, right? So a lot of times the borrower will skip a payment and then they go into the trial payment plan. So if everything goes great, trial payment 1, trial payment 2, trial payment 3, you're about 7 months out at that point from the minute you went delinquent, right? And then the servicer has about 30 days to get the docs back, get everything kind of in order. So you probably come out of that trial plan in August, maybe even September, right? So you're 8 to 9 months kind of start to finish here. And you can kind of see the numbers, right? Because Ginnie Mae is scheduled servicing. So if you do not receive a payment from your borrower as scheduled, Ginnie Mae does not care. You have to pay the mortgage-backed security holder. So there's servicers out there who have more than 100,000 delinquent loans. So yes, they made 100,000 payments last month. If we go back to, you know, a slide like this, and we just pick someone, we pick Mortgage Solutions of Colorado, 5,063 delinquent loans. They made 5,063 delinquent mortgage payments to Ginnie. So as that delinquency goes up, your servicing advances go up. Your cost to carry goes up in a big way. If that trial payment were to fail, look at this number, 30, 60, 90 days delinquent, you skip a payment, the borrower makes trial payment 1, they make trial payment 2, and they blow up and do not make trial payment 3. So they failed the trial payment plan. And since you only get one loan mod of 24 months, you're in the penalty box for a while. We have 90 days as a servicer to get first legal after the trial payment failure. So now you're probably going to foreclosure in November, December, somewhere in there. And then if that house, then you get into the whole commissioner adjusted value thing. So if you have a partial claim, the
Wait,
servicer has to bring in the
Nolan,
money
let's
for that.
step back for a moment. I want to step back for a moment. I want to get in the weeds for really quick in terms of
Yep.
HUD also just issuing a waiver in March on the trial plan payments, right? So that was a huge waiver for the industry. I feel like we need to get in the weeds and talk about it in reference to HUD determining that it is appropriate to waive the provision requiring trial plan payments be made in or no more than 15 days before the month they are due, to ensure that proactive borrowers are not penalized if they make their trial plan payments more than 15 days prior to the month. That was a big win for the industry. And then also, since you're referencing the data default and we're talking about partial payments and so forth and mortgages in default, we had the other waiver, which was very huge too in December. So I just wanted to kind of touch on that too before you go into the world of CAFMV, but also on partial claims, something that's important from a legal standpoint. HUD, I don't know, we didn't talk about this, but HUD is also looking at doing a pilot program similar to the USDA amended MRA, in which there will be no physical second lien. It will actually be a servicer advance. It will attach to the first. And so that's coming out soon. And that was stated yet last week by HUD. So soon, I'm comfortable saying that. But we also have those 2 million partial claims that Nolan referenced earlier too, that are still out there and currently in foreclosure. And you also have a decision out there from July of 2023, and it's the Show Me Premium case, in which it was held that if you have a lien held by the United States government outside of certain liens, that you have to proceed judicially in order to extinguish the lien under a federal statute. And so HUD previously released Mortgagee Letter 2024-17, and within it, it said if there's no surplus funds, you can go ahead and proceed non-judicially and then request a lien release via the SMART portal. And then they came out with an FHA info too, saying that if servicers elect to proceed judicially, then they will reimburse them according to reasonable attorney's fees. The concerns that are still currently outstanding in the industry in reference to how to proceed on these partial claims from a foreclosure standpoint is that HUD has not published any reasonable diligence timeframes if you do elect to proceed judicially. So potential curtailments down the road if they don't think that's reasonable. And when speaking with HUD and previously in the prior administration, they did issue a draft mortgagee letter proposing to have potential solutions, but they received an overwhelming feedback on that draft ML. And right now there is really, according to HUD, no regulatory fix for those partial claims that are out there. So going forward, the new program will actually help with that, with the following the amended MRA program similar to USDA, but we're still kind of in limbo right now. And there was an 8th Circuit decision, and title insurers kind of took it and then went nationwide with it. So I just wanted to highlight that.
No, I think it's a critical point, right? Because if you own servicing, I think one thing that you think a lot about is servicing advances, liquidity, cash. And if you have a partial claim fail, or sorry, a trial payment plan fail, then what happens, right? To your point, if you have a partial claim, you have a judicial lien. The judicial lien means that it's a federal lien, which means you have to do a judicial foreclosure, right? And a judicial foreclosure, Marissa, what do you think? It probably takes 2 or 3 times longer than a regular foreclosure, probably. A judicial foreclosure is probably 2 or 3 times more expensive than a regular foreclosure. And if you look at the HUD guidelines, when you file your claim, the max legal fee reimbursement is 75%. So typically, when a servicer files foreclosure, we're probably paying, Marissa, what do you think? Depending on the state, probably $3,000 on average, maybe. You're going to send a $3,000 bill to HUD. They're going to send you $2,200 back. You're going to say, dude, where's my $800? And they're going to say, you're a tier 1 servicer. You're the best there is. You get 75% max reimbursement. So every time you file a foreclosure, servicers will lose money. Therefore, this is why it's so important. We want to keep people in the house. Foreclosure is like the worst thing a servicer can ever do. We never want to foreclose if we don't have to. The other thing, I think, depending on the vintage of when that borrower has that house, if they have 20, 30, 40 grand in partial claims in arrears, they might be upside down. Because the thing that HUD will allow on an FHA loan is you can have 30% max partial claim. So if you have a $300,000 loan that you did at 100% LTV, but for some reason for the last 5 years, you've just been in a really tough spot, you could defer $90,000 or 30% of the 300 to the back of the loan, which could make you 130% LTV upside down, right? So that's something that you really need to think about. And then you have a short sale scenario versus a foreclosure scenario, or you have a claims process, which you have to send to HUD. And right now, I want to say the conveyance timeline to HUD when you have to file that conveyance claim is somewhere around 300 days. So it might take you a year to get to foreclosure. It might take you another year to get through the conveyance to actually get paid.
And I want to highlight too, since I know we're predominantly talking about HUD, but you also have USDA, right? USDA came out with guidance for Show Me back in July of 2024 saying to proceed non-judicially. And then VA, when they came out with the new partial claim law, HR 1815 in July, and then via the Continuing Appropriations Act in August, they actually included Show Me language. So that's helpful, but we also, I'm not going to skip forward, but also we know that VA, when they proposed their draft policy that they're going to be publishing soon on partial claims, they're going to follow similar to the same structure as USDA for the amended MRA and not have a physical lien. So then obviously no Show Me issue, right? And then I also know that VA is coming out with forthcoming policy. This is literally when I heard this, it made my year. I think I did a happy dance because VA stated they're going to be coming out with their circular addressing Show Me. So woohoo! But it's been an interesting thing since the decision came out, and I know HUD has done everything they possibly can on it, and we're very appreciative on that. And each agency is set up differently from a regulatory standpoint, and so there are some limitations, but VA is coming out with the circular, and USDA came out with that bulletin back in July of 2024. And if anybody wants that, I think it was archived, so you can't actually get it on the website anymore because they streamlined the USDA website like all the agency websites. I have a copy of it.
Love that. Love that. Aaron, questions, comments?
Yeah, so I know there's been a good conversation with Jennifer McGinnis in the chat, just kind of talking more on Show Me, which is definitely a big issue. And in hearing Matt Jones at 5-Star last week, I believe, that Show Me is also on their radar and they're working on a go forward fix. So I think that's something else that we should be on the lookout for. We are in the last 13, 14 minutes or so. And I know we wanted to also touch on some subservicer oversight items. And so two things. One, Marissa, if you perhaps want to throw your email in the chat in case people want to reach out to you for that. If you're comfortable with that. And then also maybe we can touch on some items. I think a lot of our members do subservice. And so I think kind of as we go into a period where we may be experiencing delinquencies, I think it's very important for us to understand how we need to be ensuring that our subservicer is doing the right steps in the timely manner. So maybe we can touch on that and before we close out.
Yeah, would love to. So these are the things that I think matter, right? And just to make clear, this isn't kind of a sales pitch for Carrington and all, but where we are as a subservicer and where we are as a company is like kind of different than a lot of other people. And I think that most IMBs probably fall into this realm as well. So Carrington will go out and we'll buy MSRs. In fact, we bought hundreds of billions of dollars in MSRs, right? We transferred millions of loans from hundreds of counterparties across thousands of transactions. So the things that matter, like if you are the asset owner, are things like this, right? What is the level of borrower service? So there's different kinds of servicers. There's people who are extremely high touch. And when I say high touch, you're really thinking about, well, how many subservicing clients do you have? Do you have a small enough amount of clients that you can be extremely custom in how you want those loans serviced, right? Or are you going to be big box where maybe I have 50, 100, hundreds of subservicing clients, and look, customizing this for 100 people, 150, 300 people, impossible. You can't do it. So that's kind of the big box experience. The big box experience might be cheaper. So if you have super clean performing loans, you're probably great with the big box shop. If you have a lot of Ginnie Mae, you have higher delinquency, and you saw the Ginnie Mae delinquency numbers, you might need a high-touch specialty servicer, right? The other thing that I think you think about are things like the customer journey. So everyone kind of wants their loan serviced a certain way, and you probably know your customer better than anyone. So what do you want that customer journey and what do you want that customer experience to be like? Can you get it at a big box shop? Maybe. Can you get it at a high touch shop? Probably. So that customer journey, I think, is really, really important, right? What's your strategy? Are you trying to recapture the borrower? Are you trying to cross-sell the borrower? Are you trying to be everything to that borrower? Do you want to hold their hand through things like property tax insurance increases, maybe ways to bite and lower their property tax? So that customer journey and that touch, that marketing is really critical. Things like co-branding, private label, white label. Do you want your name on the statement? And if you have a super delinquent book and you're going to send borrowers to foreclosure and you care a lot about headline, reputational, compliance, regulatory risk, do you want your name on the statement or do you want the subservicer's name on the statement, right? So they take a little bit of the stink. The other thing is on the co-branding, white label, private label, it probably adds $1 or more a month to your subservicing cost. So you think, well, I got 100,000 loans. I'm spending $100,000 a month. Could I spend that $100,000 somewhere else? Would I get more bang for my buck? Because if you think about the servicing statement, I'll tell you what, I've never looked at my servicing statement ever. The only time I call my servicer is when I'm mad because my property tax or insurance or something went up or I have an issue. And I've literally never called Wings Financial Credit Union in Minnesota ever. So sometimes you can spend a lot of money on that co-branding private label. Your borrowers may or may not care. If you're doing heavy portfolio retention, recapture, and you need to stay in front of them, maybe it matters a little bit more, right? So the portfolio retention recapture, you got to think about, okay, what is your servicer just a servicer, or do they even do portfolio retention recapture? Like Carrington's a lender, we're a servicer, we're a real estate brokerage firm, we have the title company, we have the vertically integrated continuum. Some servicing shops have that. Rocket, for example, has a lot of that. Other shops don't. So this kind of goes back to that level of service that you need. Is it high touch? Is it big box? Other things like availability of reporting, data, and analytics. How custom do you want to get? Like, how nerdy are you? And moreover, are you getting the right data? And are you getting the right analytics? A lot of times you get a bunch of stuff and you're like, yeah, that's really nice to know, but can I trade on that data? You told me a bunch of stuff, but if I can't monetize it, do I really care? So I think understanding the data that you want and the data that you need is really important to monetizing that MSR, that servicing asset that you have. Maybe I'll stop here just for a sec, see if Marissa or Aaron want to weigh in anywhere.
No, I think it's really important too. And from you mentioned it in your one bullet, regulatory compliance and risk management. I think it's really important to stay on top of what's coming out of the agencies and then also kind of thinking forward too of what potentially could come out. We're referencing a lot of draft policies right now, but it's important to know what those draft policies are and then what they might look like when they're actually published. I know in the VA draft policies, over 800 comments were submitted on the partial claim draft, partial claim and loss mitigation chapter. So kind of really staying on top of all those things. And I will tell you, everything is coming from everywhere right now. And when I say that, I mean, when I'm going to the Federal Register every morning, my search has expanded to like 10 different agencies looking for things. GAO is coming out with great publications, great informative stuff. Like yesterday with the Vantage Score announcements, GAO actually has a whole entire report on why that matters, why that's a difference. And then, of course, Congressional Research Service is also coming out with a lot of great materials. So kind of really staying ahead, one step ahead, keeping up with everything that's coming out. One thing that we didn't get to discuss too was presidentially declared major disaster areas. We're seeing a lot more PDMDAs being declared, and HUD's handbook specifically does say moratoriums do impact public assistance, individual assistance, and or both. And one of the updates in the handbook back from November was that servicers must have communications with those borrowers in those counties. It didn't say how you had to have communications. I want to clarify that because some people are like, oh my gosh, do I have to send a letter? It just said you need to have communications with them. So there's so many different things going on. So really being like on top of that, I think is really important.
Yeah, I would agree. And then I think I'll only just say is just kind of reinforce this, that picking a subservicer is not just pick the lowest cost and move on to check a box. It's part of your strategic plan as an organization. And I think Nolan hit on some really good points that when making that decision and thinking about that, you need to think about just not, okay, what name do we put in the box and move on? It's what is our overall strategy and how do we find the best partner to deploy that?
100%. Yeah, I think like the regulatory and compliance and risk management thing is huge, and you want to make sure your subservicer has like they're big enough and they have enough scale to Marissa's point. Like this stuff comes quick, it comes frequent. Like a lot of times you have to implement it in very short periods of time, and you have to kind of figure out how that's going to work across all of your clients and customers, right? What's the effects? What's the scale? So having dedicated teams that track that stuff is critically important. And then that generalist or specialist, right? Like at Carrington, for example, we're the master subservicer for Ginnie Mae. So we're hyper focused on Ginnie Mae, FHA, VA, USDA, public Indian housing. We get Ginnie better than I think just about anyone in the country. We also lend probably 150 million a month in non-QM. So the private label non-QM market, we get really well. We're a high touch specialty servicer for Fannie. So when Fannie Mae has to pull loans, move loans, Carrington takes those loans. We subservice loans on behalf of Ginnie Mae, the federal government, and Fannie Mae, the federal government. So other shops might just be a specialist in, hey, we're going to be the lowest price, but we're really good at super clean performing loans. Other shops might say, we're really good at default, right? So I think finding out what that company focused on, what are the key differentiators, like at Carrington, for example, we buy loans with our own money. So we set up our servicer to really drive ROI. We have to return, mid-teen returns to investors who give us money for MSR. That's how that has to work. Cooper is very similar, right? They have a lot of investors who service their loans there, and those investors are going to demand a different level of servicing and differentiation, right? So the specialization and scope is really important, and the loss mitigation, right? Are you doing the minimum or are you going above and beyond? Are you doing outbound calls to borrowers? Are you calling the borrower 3 days before the payment is due and saying, hey, Billy, don't forget, if you fail this tryout payment plan, you don't get another mod. You're in the penalty box for 24 months. So is there any type of active outreach, outbound collection calls? Are they answering the phone in the allotted period of time? Are they just doing the absolute minimum that the guide requires, right? So that's something you certainly want to ask. Technology tech stack is important. Is AI involved in this? Are you offshoring? Are you outsourcing? There's really only three systems in the servicing world. There's MSP, which is by ICE. There's Sagent, and the new kid on the block is Valen. There's a couple others that are starting to be up and coming, but those are the three big ones. So what system are you on is certainly important, and certain systems can do certain things. Like Sagent, for example, is a little bit stronger in the Ginnie space. That's why you see Cooper and Freedom and Carrington on it. There's a lot of opportunity to kind of customize those workflows, especially for things like Ginnie Mae and loss mitigation, which are a little more technical. And I think Valen will get there in a big way as well over the next year or two. And then finally, the cost structure side of it. Like the cost structure can be really convoluted. I've seen subservicing pricing that's 5 pages. Ours at Carrington is 1 page. Everything's kind of included. You might be $6 for a subservicing fee, but then you might have a statement charge. You might have a technology charge. You might have a reporting charge. You might have a million add-ons. So finding out what the bottom line out the door price per loan per month is critically important. And then I think this is the last slide. So Marissa, Aaron, anything else before I go to the last one?
No, sorry, go ahead.
The last thing I just wanted to say, don't forget about the CFPB. They're still there, they're still active, and they're still looking at making changes to Regulation X. So don't forget about that.
Zero has changed in CFPB land. Just because there are not as many people, all those laws still exist. And keep in mind, when you get audited and someone comes to your shop 3-4 years from now, they're going to look back 3 or 4 years and they're going to say, hey, remember this law never changed. How come you aren't compliant? So I think like that's really, really important. Do not cut corners in compliance or regulatory stuff. Like that is as serious as it can get. And you might be in, for all we know, in the next, couple of years, you might have 50 state AGs regulating you or state bank supervisors, the whole thing. So the regulatory environment is very dynamic, and CFPB is very much alive and well.
Correct. Yep.
Yep. So question to ask, if I was going to subservice my loans, if I'm in your shoes, these are all the questions that I ask, right? A borrower calls. At Carrington, we think you get one shot to talk to a borrower, right? You miss that call, they're never calling you again. And you kind of saw, what I talked about earlier, going back to the ostrich phenomenon here, where 10%, 17% of those borrowers are no contact. If that borrower calls you, you better answer the phone. It's really important. So speed to answer, it should probably be under a minute or two at the most. Call abandonment rate. How many times do you get a borrower on the phone and the call gets disconnected? They get mad at you, they hang up, they get tired of waiting, they hang up. That abandonment rate should be 1%-ish or less, probably. Maybe 1.5, 2 at the absolute most. If it's higher than 2, something's going on. Your average talk time. So some servicers will limit this. They only have so many employees, and you have a really high loan count per FTE. Some servicers are 2,000, trying to get to 3,000 loans per one FTE. Higher touch servicers are probably 500 to 750 loans per one FTE, full-time employee. And when you go into delinquency, that FTE should drop big time. So when you go into delinquency, you might be 100, 150, 200, 250 loans per FTE. If you're 1,000, 1,500 and a loan 60, 90 days, something's wrong. So ask about FTE, when you talk about that kind of stuff. The one call resolution rate, how many times do you solve the problem the first time the borrower calls? Do you really want to call 3 times for the same question? So that number should be 95, 97, 98%. The higher, the better. Asking how the loss mitigation process works, right? Are you doing the minimum? Are you doing what the guide requires? Are you going above and beyond? The FTE for performing, we talked about what day do they go to single point of contact? So a lot of times when the loan goes delinquent, you want that borrower to know one person. Nolan is my guy. Every time I call, I talk to Nolan. Nolan's only managing 100, 150 loans. He knows me. He knows the whole thing. So does that SPOC happen at day 16? Does it happen at day 60? Does it happen at day 180? When does single point of contact come in? You really need to know that. And you should really ask the question of how they're minimizing loss, maximizing value, and shortening the duration of the default life cycle. So like what Marissa was talking about, judicial, non-judicial foreclosure, do you really know all the regulatory stuff? Are you working with the right attorney firms? Like some of these attorney firms get loans through foreclosure way better than others. So I think, having the right vendors is a huge part of minimizing loss, maximizing value. Are they using a bunch of third parties that are driving up cost or elongating the timeline? All stuff to think about. And the headline, reputational compliance regulatory risk. What are you doing to mitigate that? Because no one wants to be on the front page of the Wall Street Journal. No one wants a big fine from the CFPB. So do you have the resources? Do you have the internal controls to do all of that? You think about something like cybersecurity. Do you have SAS 70, Type 2, SOC 16, 18? Are you NIST certified? Do you have anti-ransomware, anti-penetration stuff? It's all really, really important. And, for me, the high touch specialty servicing, right? Especially if you had Ginnie Mae loans, you got to have that. So ask them, why are you high touch? What makes you high touch? Like, how do we know? Are you talking to the borrowers more? Is it the call center? Do you have AI? Do you have really good tech that walks you through a borrower journey? Are you using chatbots? Are the chatbots real? Are they good? There's a million questions you should probably ask around there. The data and analytics drive the decision making, super important. Do you treat Ginnie Mae, Fannie Mae, Freddie Mac, non-QM, do you treat them different? At Carrington, we do. And your subservicer should as well. Things like property tax, escrow, home insurance, you saw the delinquency rates, you saw how much they've went up. We're analyzing that 2 to 3 times a year. If your servicer is doing it once a year, it's not enough. At Carrington, for example, we work with insurance companies. So we will actively shop for our borrowers' home insurance. So if we can save them $500, $700, $1,000 a year, we're shopping for that insurance 3, 6 months before it comes due, trying to pass that savings on. Is your servicer doing that? Because that is a way you can lower delinquency, and it's really important. And then, Marissa's favorite part is the regulatory guide changes. As you know, this is going to probably happen more and more, especially as you see, delinquency start to change. So all super, super important stuff. And the final one is the performance you're getting really worth your monthly subservicing fee. You're paying them all this money. Are they doing what you want?
Well said. Thank you so much. Really, really appreciate it. We are a little bit over time, but this was amazing content. If you email me, I put my email address in the chat. I will send you the recording of this. Marissa, welcome to TMBA. We're so excited. Thank you for your first. We will see you at convention next week. Nolan, as always, this was phenomenal. You are just a gem and a wealth of knowledge. Thank you to everyone for participating. Hope you guys have a great day. We'll see you later.
Thank you.